In 2025, the question, "Where should I put my money now?" has become the most important financial decision of the decade. Silver, gold, and crypto are all moving in ways that signal the world is entering a new monetary cycle, one defined by weakening currencies, sovereign debt strain, and accelerating geopolitical fragmentation. But here's the truth no mainstream financial analyst will tell you. These three assets are not competing with each other. They are competing against the collapse of trust in fiat money and understanding how each asset behaves in crisis, who controls the supply, who manipulates the price, and who benefits during instability is the key to navigating the next 12 to 36 months. So before we break down the numbers, the flows, the structural forces, and the historical models that determine which of these assets has the highest probability of outperforming in 2025, make sure you stay with me until the end, because the difference between gold, silver, and crypto is not just performance, it's survival. And once you hear the real mechanics behind these markets, drop your thoughts in the comments, because this is one of the most important discussions we will have on this channel. Let's begin with gold, the anchor of the global monetary system for over 5,000 years. In 2025, central banks are buying gold at the fastest pace since the 1960s, over 1,100 tons per year, for one simple reason: it has no counterparty risk. Gold is the only reserve asset that is not based on debt. When banks, governments, and sovereign funds buy gold, they are not trying to make a profit. They are trying to survive. Gold isn't just a hedge, it is geopolitical insurance. And right now, trust in government-issued currencies is eroding at a historic rate. $36 trillion of U.S. debt, commodities inflation, currency devaluations from emerging markets, capital controls, the rise of BRICS, the shift away from the petrodollar. All of these pressures push monetary systems toward hard assets, and gold is the first destination. But here is the part most people don't understand. Gold is playing defense. It protects wealth, but it does not multiply it quickly. Gold is the anchor, but it is rarely the accelerator. In a crisis, gold rises because the world is losing confidence in everything else, not because gold itself changes. Silver, on the other hand, behaves differently, and 2025 is exposing this difference more violently than any time in modern history. Silver is not just a monetary metal. It is the world's most indispensable industrial metal, powering solar panels, EVs, AI data centers, military technology, and high-efficiency electronics. When gold rises, it signals a monetary shift. When silver rises, it signals a structural shortage. The silver market is small, fragile, and heavily dependent on byproduct mining, meaning miners cannot increase supply even if prices soar. For every 1 ounce of primary silver mined, 7 ounces come from copper, zinc, lead, and gold mines. That means supply cannot scale with demand. Meanwhile, the world is consuming silver faster than it can replace it, creating a structural deficit of more than 100 to 150 million ounces per year. Inventories are draining. COMEX vaults have been cut nearly in half since 2020. Premiums are rising globally. And industrial demand is growing so fast that analysts now estimate solar manufacturing alone may require 200 million ounces annually by the end of the decade. Unlike gold, which is hoarded, silver is consumed. It disappears into products that never return to the market. This is why silver tends to explode later than gold, but when it moves harder. Silver is the high beta version of gold, the asset that reveals when the system is hitting real supply limits, not just monetary anxiety, and because the silver market is microscopic compared to gold or crypto, roughly 1.5 trillion for gold versus 40 billion for silver, a relatively small inflow of capital can trigger a massive price revaluation. This is why governments, banks, and major industrial players often intervene to suppress volatility through paper markets. Futures contracts, unallocated silver accounts, and ETFs create layers of synthetic supply that prevent prices from reflecting scarcity. But paper can only suppress for so long. When physical shortages intensify, the paper price loses control. That is when silver becomes the most powerful asymmetric asset in the world. Crypto, however, is a completely different creature. While gold and silver are anchored in physical scarcity, crypto, especially Bitcoin, is anchored in mathematical scarcity. Bitcoin's fixed supply, decentralized nature, and halving cycles create a predictable pattern of booms and consolidations. But beyond Bitcoin, the crypto market is volatile, speculative, and heavily influenced by liquidity conditions. When interest rates fall, crypto skyrockets. When liquidity tightens, crypto crashes. In 2025, the Federal Reserve is signaling rate cuts, global liquidity is starting to return, and institutional adoption is increasing. But here is the crucial insight. Crypto behaves like a digital growth asset, not a crisis asset. It performs best when people feel optimistic, not afraid. It outperforms when the world believes the system will change, not collapse. Bitcoin is becoming a digital store of value, but it is still correlated to risk on behavior. That makes it powerful, but not yet reliable during structural supply crises, like the one building in silver. So where do you put your money in 2025? The answer depends on your time horizon, your risk tolerance, and your understanding of what cycle we are in. Gold protects wealth. Silver multiplies wealth during structural shortages. Crypto accelerates wealth during liquidity expansions. But only one of these assets is facing a once-in-a-century supply crisis. Only one is being quietly accumulated by governments behind closed doors. Only one is essential for global technology, energy infrastructure, AI systems, and national defense. Only one is on track to experience a forced repricing due to physical scarcity, not speculation. And that asset is silver. Stay with me to the end of this video, because in the next section, I break down the specific allocation models for 2025, the historical patterns that determine outperformance, and what most analysts completely miss about how these three assets behave during monetary resets, liquidity shifts, and supply shocks. If this is helping you understand the real picture, let me know your thoughts in the comments below. Let's get straight to the point and talk about what really matters, how silver, gold, and crypto behave when the world gets messy. When monetary cycles shift, governments step in, liquidity vanishes, and the entire system starts to crack. Because picking an asset isn't about what sounds good or feels safe. It's about understanding where the world is actually going and knowing which asset wins in each phase of a global financial reset. And let's be clear, 2025 is not a normal year. We are in the final stage of a massive pattern that repeats every single time global debt hits a saturation point, faith in currencies crumbles, and supply chains break under geopolitical pressure. This cycle doesn't care about your opinion. It runs on pure math, structural scarcity, and the flow of money. So let's break it down with brutal clarity. First, you have to understand that global debt cycles are the puppet master pulling the strings of asset performance. Every major cycle, from the 1930s to the 1970s, the early 2000s, and now the 2020s, follows the exact same path. It starts with rising debt, which leads to rising inflation. That causes a loss of trust in currency, which then forces a flight to hard assets and, ultimately, a systemic reset. In the early phases of this cycle, gold always outperforms. It's the first asset big institutions run to when the dollar shows weakness. Then, in the middle phases, crypto takes the lead. This is when central banks inject massive amounts of liquidity into the system, pushing digital assets into explosive parabolic growth. But it's the late cycle conditions that we need to focus on right now. This is where we are today. Deficits are permanent, trust is eroding daily, and critical supply shortages are colliding head-on with monetary stress. In this environment, one asset stands out: silver. Why silver? Because it's the only asset that benefits from two massive forces at once: monetary fear and industrial necessity. It's the only asset that surges when the financial system weakens and when industrial demand goes through the roof. Think about it this way. Gold rises because money is breaking. Crypto rises because liquidity is expanding, but silver rises because the real world is physically running out of it. Now let's talk about the supply dynamics, because this is the part that determines just how extreme the price movements can get. Gold has deep, well-known reserves, a steady recycling market, and massive stockpiles sitting in vaults all over the world. Bitcoin has a perfectly predictable supply schedule that's coded into its DNA. It's immutable. Silver has none of these stabilizers. There is no large strategic above-ground silver reserve. Recycling is incredibly limited because most silver is used in such tiny amounts in products that it's just not economical to recover it. And mining simply cannot scale up fast enough to meet demand. This creates something that neither gold nor crypto can ever replicate: forced scarcity. When the supply of an industrial commodity hits critically low levels, the users don't just choose to buy it. They must buy it at any price, or their entire production line shuts down. This is why silver's potential upside is dramatically higher than gold's or crypto's in a true resource-driven crisis. Silver doesn't just store value, it gets fought over. But of course, we have to bring crypto into this analysis. Ignoring it would be completely foolish. Bitcoin has proven itself as a powerful hedge against the printing of money and as a technological alternative to our outdated financial system. Ethereum and other networks are building the infrastructure for a new digital economy. Crypto is not going away. It will absolutely continue to play a crucial role in global liquidity cycles. However, crypto's weakness is very straightforward. It relies on electricity, internet infrastructure, and, most importantly, the expansion of liquidity. During periods of tightening money, rising geopolitical tension, or major supply chain shocks, crypto becomes extremely volatile because it isn't tied to a physical resource. This makes it incredibly powerful during growth phases, but very vulnerable in supply shock phases. To put it simply, crypto thrives on optimism. Silver thrives on necessity. Crypto is a bet on the future. Silver is protection against the present. So this brings us to the ultimate question of this entire video. Where do you put your money in 2025? Here is the honest, direct breakdown. This isn't financial advice, but a pattern analysis based on history, cycles, supply constraints, and macroeconomic behavior. First, gold. Think of gold as the stabilizer. You use gold to protect your wealth, not to multiply it. It's ideal for long-term stability, hedging against geopolitical risk, and protecting against currency devaluation. Gold will do well, but it won't be the top performer. Next, crypto. Crypto is the accelerator. You use crypto for its asymmetric upside during periods of liquidity expansion. Bitcoin remains the strongest macro trade in the crypto space, but its volatility will remain extreme, swinging wildly depending on what the Federal Reserve does and how much money they pump into the system. Finally, we have silver. Silver is the asymmetry. It's the only asset positioned to benefit from a monetary crisis, an industrial shortage, and geopolitical fragmentation, all happening at the exact same time. This triple convergence only happens once every few decades, and when it does, history shows it leads to an explosive revaluation. If investors truly understood how tiny the physical silver market is, how fragile its supply chain has become, how rapidly industrial demand from things like solar panels and EVs is accelerating, and how heavily governments are now intervening in strategic metals, they would realize that silver is not a commodity. It is a bottleneck to modern civilization. And that brings us to the logic of allocation, the part most investors get completely wrong. In a monetary reset, you don't diversify by asset class, you diversify by function. Gold is your insurance, crypto is your growth engine, and silver is your compression and breakout play. A balanced macro strategy for 2025 would acknowledge that all three of these assets have a critical role to play. But if you were to ask me which one of these has the highest probability of a violent upside move under current global conditions, the answer is silver. Not because it's trendy, not because of hype, but because the industrial world cannot function without it, and supply cannot increase fast enough to prevent a crisis. Now consider this final critical point. When reset conditions accelerate, governments intervene. They freeze markets. They impose capital controls. They slap on windfall taxes. They regulate exchanges. They throttle liquidity. We have already seen this happen with both gold and crypto. But silver is different. Governments do not have strategic silver reserves to dump on the market like they do with gold. They cannot suppress its mining the way they can with oil, and they cannot print a digital equivalent like they can with currency. When the silver market breaks, they have no tool to control it. That's why the final phase of a silver bull market is historically more violent than gold or crypto. Gold is owned by governments. Crypto is controlled through regulation. Silver belongs to no one, and everyone needs it. So here is the brutally honest conclusion. If you want stability, gold works. If you want volatility with the potential for massive upside, crypto works. But if you want to front-run a structural shortage, a monetary reset, and an industrial supply crisis all converging at the same time, silver is the highest probability asymmetric play of 2025. This isn't speculation. This is math, history, and physical reality all colliding at once. If you watched this far, I want to hear from you. Drop your thoughts in the comments below. Where do you think we are in this cycle? And which asset do you believe wins this decade? Thanks for watching.